5% down, a 30-year mortgage, and a little line on your statement called PMI that you could pay every single month to protect the bank. If that's you, this video is your escape plan. I'm going to show you the real numbers, exactly how to pay off a 30-year conventional loan in 12 years. Fire your mortgage insurance years ahead of schedule and keep about $335,000 the bank is currently planning to take from you. And no, you don't need to refinance, you don't need to win the lottery, and you don't need some weird banking trick from the internet. You need 3 moves. Simple math, done purpose every single month. I'll show you every step with the exact dollar amounts on the screen. And stick around, because I'm also going to show you how to run every one of these numbers on your own loan in about 30 seconds with the calculator on the phone. This is the plan I wish someday or somebody had handed me with my first mortgage. Let's get into it. Quick note before we start. I'm a licensed mortgage broker, and this is education, not financial advice for your exact situation. I'm using clean, round numbers today so you can see how the machine works. Your rate, your balance, and your budget will be different, and that's fine, because the moves work exactly the same. Use this to understand the plan, then talk to a licensed pro before you move real money. Oh, and one quick favor before the numbers. Tap the like button for me. It costs you nothing and it takes 1 second, and it genuinely helps. Okay, let's meet the villain. The villain of this video is not your interest rate, and it's not even the bank. It's a boring piece of paper called the amortization schedule. And it is quietly designed to collect the maximum amount of interest from you. Here's our example, and it probably looks a lot like your real life. You bought a $400,000 house. You put 5% down. That's 20 grand. So you borrowed $380,000, 30-year fixed at 6.5%. Your principal and interest payment comes out to about $2,400 a month. Now watch this. Out of your very first $2,400 payment, about how much do you think actually pays down your loan? $344. That's it. The other $2,058 is pure interest. You wrote a check for $2,400 and your loan balance barely moved. And I want you to see exactly why. Because this is the machine the bank hopes you never look at. Here's how every mortgage payment on earth gets split. Take your balance, multiply it by the rate, divide it by 12. That's the interest slice of this month's payment. And it gets paid first before a penny touches your loan. Watch it with our numbers. $380,000 times 6.5% is $24,700 a year. Divide that by 12 and there it is. $2,058 off the top every single month before your balance moves at all. And because the balance barely drops in the early years, the interest slice barely shrinks. That's what front-loaded means. It's not a trick. It's not a rate trick. It's just math working against you while the balance is big. In the early years, you're basically renting your house from the bank. Want to feel how slow it really is? Fast forward to 5 years on the normal schedule. By then, you've written checks for about $155,000 plus mortgage insurance. So how much of a house did that money actually buy you? $24,000 after 5 years. You still owe $355,000. Meanwhile, way out in year 25, the exact same $2,400 payment sends about $1,700 towards your principal instead of $344. Same check, 5 times the progress, but just because the balance finally got small. So the whole game today is simple. We're going to shrink that balance early on purpose. So the good math shows up decades sooner. Because you put 5% down, there's a second building riding along. Private mortgage insurance, PMI. Here's where that bill comes from. PMI is priced as a slice of your loan amount. On a loan like this, call it about 0.6% a year. 380,000 times 0.6 is 2,300 a year. Divide that by 12, that's about $190 a month on your statement. And here's the part nobody tells you. That insurance protects the lender, not you. If everything goes wrong, PMI pays the bank. You're paying every month for their protection. So add the whole thing up, ride this loan for the full ride 30 years, and you'll pay about $485,000 in interest on a $380,000 loan. All in, you'll hand the bank roughly $865,000 for a $400,000 house. And the PMI hangs there for more than 11 years on the normal schedule. That's over $25,000 for insurance that isn't even yours. That's the plan the bank printed for you. Now let me show you the plan we're going to run instead. But real quick, because this is the moment it matters. If that 344th number just made something click, if nobody ever showed you how your own payment actually works, tap that like button. And if you want more plain English money breakdowns like this one, hit subscribe while you're at it. Here's the honest reason I asked. This channel is still small, and every single like and every subscribe tells YouTube to show this video to the next homeowner who's starting at a 30-year schedule thinking it's a life sentence. It's free. It takes only 1 second, and it's the biggest thing you can do to help me make these. Okay, here are the 3 moves. Move number 1, attack the principal directly. Every extra dollar you spend, marked, apply to principal. Skips the interest line completely and hits the balance dead on. And because the schedule is front-end loaded, early dollars are superchargers. At 6.5%, $1 extra principal in year 1 saves you roughly $5 more of interest over the life of the loan. Send an extra $500 this month, and you just erased close to $3,000 of future interest. Send an extra $1,000 this year, about $5,000. No savings account pays you that, but you have to send it, right? So write this down. 1, mark the extra as principal only in the payment portal on the memo line. 2, check your next statement, because some servicers will quietly mark that money as an early next month payment, which does nothing for you. Keep making your normal regular month payment like normal. Extra means extra on top, not instead. And before we go to move 2, pause, run this on your own loan. Right now, if you want, I'll wait. Grab your last mortgage statement, take your current balance, multiply it by your rate, and divide it by 12. That's this month's interest slice. Now subtract that from your principal and interest payment. And that's what's left. And what's left is the only part of your check that's actually buying your house. Most people do this once and get mad. Good, mad as fuel. Drop your number in the comments, because I genuinely read every one. Move number 2, fire your PMI years early. Here are the rules almost nobody reads. On a conventional loan, federal law says PMI cancels automatically when your balance pays down to 78% of what the home was worth when you bought it. On the normal schedule, our loan doesn't get there for more than 11 years. But here's the part your servicer will never call to tell you. You have the right to request cancellation at 80%. Just asking on the phone call saves you about $2,000 versus waiting for the automatic cutoff. You need a decent payment history and no second lien on the house. But that's it. And this matters even more than you think, because when you make extra principal payments, that automatic cancellation doesn't speed up, it runs on the original schedule. The request is how your extra payment actually killed the PMI. Now, watch the moves stack. On a 12-year plan, I'm about to show you, you don't reach 80% in year 10, you reach it in under 3 years. So instead of paying mortgage insurance for 11 plus years, about $25,000, you pay it for less than 3, about $6,000. You just keep roughly $19,000. One more pro tip while we're here. If home values in your area have climbed, you might not even need to wait for the paydown. Most servicers will let you cancel based on a new appraisal. Once you have enough equity at today's value, usually after a couple of years of payments, a phone call and a few $100 could delete the bill this year. And when the PMI dies, that's $190 a month does not go back into your lifestyle. It rolls straight into move one, extra principal every month automatically. The villain starts funding your escape. Move number 3, run the 12-year schedule. Here's the headline number for our example. To pay off that $380,000 loan in 12 years, you pay about $3,800 a month of principal and interest of $2,400. That's about $1,400 extra every month. Now, before you close the video, hear me out, because that number is a dial, not a pass-fail test. Look at the ladder. An extra $200 a month pays the house off almost 6 years early. It saves you about $110,000. An extra $500, you're done in about 19 years, and you keep around $200,000. An extra $1,000 done in a little over 14 years, saving about $280,000. And the full 1,400, 12 years, and about $316,000 of interest stays in your family instead of moving to the bank side of the table. Every rung on that ladder wins. Pick the one you can actually hold. And you don't have to start at the top. Here's how real people climb. Start with whatever you have. And even 200, add the biweekly trick, pay half your payments every 2 weeks. And because of the year has 52 weeks, you sneak in a full extra payment every year. That's another $200 a month on this loan without really filling it. Quick flag on that one though. Do it yourself for free by just sending the extra principal. If your servicer offers a biweekly program with a setup fee for a monthly charge, skip it. You can do the exact same thing for nothing. Then in year 3, when the PMI rolls off at 190, every raise give half of the house. Tax refunds, bonuses go straight at the principal. Stack all of that at 1,400, stops sounding crazy. 2 quick warnings while we're here. If your servicer ever offers you a recast, understand what it does. A recast uses your extra principal to lower your monthly payment and stretches you right back out in the same clock. That's the opposite of this plan. So politely decline, and prepayment penalties on today's conventional loans, they're basically extinct. But it never hurts to glance at your note. Something or nothing is stopping you. Now, some of you are already thinking, wait, why not just refinance to a 15-year loan? Fair question. And honestly, sometimes that is the right answer. 15-year money usually comes with a lower rate, But understand what you're trading. A refinance cost, real closing cost, and it locks you into the bigger payment forever. Miss a raise, lose a job, have a baby, and that higher payment is still legally due every single month. The plan I just gave you gets you nearly the same result with the loan you already have. Zero closing costs and a dial you control. Tight month, drop back to the regular payment. No penalty, no phone call, no drama. Flexibility is flexibility is worth a lot when life happens. If you got rock solid income and the rate gap is wide, talk to a broker and then run the 15-year math side by side. For most people, the dial wins. So, what does the 12-year plan actually feel like live? Let me fly you down the timeline with the real balances on the screen. Year one, you're sending about 3,800 and the balance drops by over 21,000, about 5 times more than the normal schedule you've managed. You end year one owing about 358,000. Just before year three, you cross 80,000. You make the phone call. The PMI is gone. 19,000 stays at home, and another 190,000 a month joins the attack. End of year five, you're down to 256,000. And remember where the normal schedule sits at year five, 355,000. You are $100,000 ahead of the version of that did the version of that didn't watch the video. You're around year seven, you cross the halfway line and something beautiful happens. The schedule that used to work against you flips sides. Remember when your whole payment was interest. Now almost every payment is pure principal and the balance starts melting. By year 10, you're under $90,000 and the interest slice is barely $500 a month. And one day in year 12, you make a payment and the screen shows zero. The house is yours, free and clear, 18 years ahead of schedule. And hey, if watching that balance melt did something for you, the like button is right there. Now, the honest fine print, because I promised you real talk. And some people should not run this play yet. Before one extra dollar goes to the mortgage, 3 boxes have to be checked. Box one, your high interest debt is gone. If you're carrying a credit card at 24%, paying extra on a 6.5% mortgage is math malpractice. Kill the card first. Box two, you have a real emergency fund. 3 to 6 months of expenses, because the catch with prepaying a mortgage, the money goes into the walls and the walls don't give it back easily. If you lose your job in year four, the bank does not care that you're 80,000 ahead. They still want the next month's payment. Box three, you're grabbing your full employer match if in your retirement account, because that's an instant 100% return and nothing on my ladder beats it. And let me give you the fair fight too. Some smart people will tell you to invest the 1,400 instead because the market might earn more than 6.5%. This is a real debate. And on a spreadsheet, it can go either way, but the mortgage payoff is guaranteed. It's tax-free and it buys something a brokerage account can't print, a paid off house nobody can take from you. Plenty of people split the difference, half to the house, half invested. That's allowed. This is a peace of mind play as much as math play. And here's my favorite part, the part almost nobody talks about. The day the mortgage dies, you don't just save money. You've unlocked $3,800 a month raise. That's over $45,000 a year every year with paid off house under your feet. That's colleges handled money. That's retired early money. And if you catch the investing bug, that's a down payment on a rental property every single year, which is the other half of the channel. And honestly, the fun half. I've even wrote a book about financing rentals, DSCR loans made simple. It's linked down below. And if that's where you're headed next, so here's the whole plan on one page. Move one, attack the principal. Extra dollars marked principal only, and early dollars pay you back 5-1. Move two, fire PMI. Request the cancellation at 80%. Don't wait for 78%, then roll the savings into the loan. Move three, pick your rung on the ladder. $200, $500, $1,000, or the full $1,400, and lock in your payoff date. On your $400,000 house, the full plan turns 30 years into 12. It keeps about $335,000 on your side of the table. And remember, this is education, not personalized advice. Everybody's loan rate and budget are different. So before you make big money moves, talk to a licensed pro. This is generally what I am here for. It's what I do all day. Now, before you go, I'll ask you straight. If this video showed you something about your own mortgage that nobody ever explained to you, hit that like button and subscribe to the channel. I don't say that as a throwaway line. This channel is still small, and every single like and every subscribe tells YouTube to show this to the next homeowner who thinks a 30-year schedule is just fine, how life works. That person might be somebody you know. So if I earned it today, tap the like button and hit subscribe, and drop me a comment with your payoff year. Look at your loan, pick your rung on the ladder, and tell me the year you'll be done. I'll see you in the next one.